Imagine a man. He is 52 years old. He works in finance, lives in a comfortable suburb outside Chicago, drives a German car, and has a wife and 2 kids almost out of college. In March of 2022, he walked into his local authorized Rolex dealer, and finally, after 3 years on the wait list, after spending nearly $40,000 on other pieces just to earn the privilege, he bought a steel Daytona at retail, $14,500. He drove home that afternoon feeling something specific, not just satisfaction, validation. The watch industry had been telling him for 2 years that what he held on his wrist would be worth $30,000, maybe $40,000 within a year. The Wall Street Journal wrote about it. Bloomberg wrote about it. His financial advisor mentioned it offhand. He did not buy a watch. He bought into a thesis. That thesis was that Rolex steel sports models had become a new asset class, a liquid, appreciating, portable store of wealth that performed better than equities and behaved more reliably than crypto. Today, 4 years later, that same Daytona is worth around $32,000 on the secondary market, which sounds great until you do the math. Because his Daytona was worth $50,000 at the peak in 2022, and he has been watching it lose value for 2.5 years straight. And he is, statistically, one of the lucky ones. Welcome to MONARC. Today we are talking about the quiet, mostly unspoken financial unwinding happening to Rolex collectors right now. Not the dealers, not the flippers. The actual people who bought one watch, intended to wear it, and were sold a story about appreciation along the way because the story is over, and almost nobody is writing about what comes next. Let us go back to where this started. Between 2020 and 2022, 3 things happened simultaneously that created the most distorted luxury watch market in modern history. First, interest rates collapsed to near zero, which made every alternative store of value, including bonds, savings accounts, and money market funds, economically pointless. Second, the pandemic shut down global travel and entertainment, leaving high-income professionals with unprecedented savings rates and nowhere to spend them. And third, crypto went vertical, creating a new class of paper millionaires who needed somewhere to park gains that would not immediately attract tax attention. All 3 pools of capital found the same destination, the steel Rolex sports model. By March of 2022, the watch chart's overall market index hit an all-time high of around $36,500. A steel Daytona traded for $50,000. A Pepsi GMT traded for $26,000. A Green Dial Submariner traded for nearly $30,000. Every reference your dealer would not sell you at retail was trading at 2, sometimes 3 times its sticker price on the secondary market. The industry told one consistent story to justify it. Rolex was scarce. Rolex was appreciating. One frequently quoted analyst called Rolex the new gold. It was not the new gold. It was a bubble. And bubbles always end. The unwinding started in April of 2022, almost to the day that the Fed began raising rates. The watch chart's index began declining month over month, and it has not made a sustained recovery since. In May of 2026, the same index sits at around $29,600. That is nearly a 19% decline from peak, but that headline number obscures what is actually happening because the decline is not evenly distributed. The watches that define the bubble are down dramatically more than the broader index. The steel Daytona reference 100 LN has fallen from peak prices above $50,000 to current trading in the low $30,000 range. That is a 30 to 35% correction. The Submariner Hulk, the green-on-green reference that traded near $30,000 at peak, now trades closer to $19,000, a 40% decline. The Pepsi GMT, before an announcement in April that Rolex was discontinuing it entirely, fell from $26,000 to around $14,000 on the Jubilee bracelet, a 46% drop. These are not small movements. These are the kind of losses that can move a household financial plan. Almost none of the collectors who bought into the appreciation story between 2021 and 2022 have sold. They are sitting on the watches, telling themselves the market will come back, hoping the secondary will rebound to retail plus pricing again. Most of them have not even looked at what their watch is actually worth in months, because looking would force them to confront a number they do not want to see. But the more interesting story isn't the price decline itself. It's why the recovery so many collectors are waiting for is structurally not going to happen. Here is something almost nobody talks about. Rolex has raised retail prices every single January since 2022. The increases in 2026 alone were around 7% on average, with gold and Rolls or models climbing 8 to 10%. The current retail price of a steel submariner, 124060, is approximately $7,400. The secondary market price for the same watch, in unworn condition with full box and papers, currently sits between $6,200 and $6,800. Read that again. The new watch from the dealer costs more than the used watch from the gray market. Industry analysts have a term for this. They call it the retail price trap. It is the moment when buying a watch new at full retail becomes economically irrational compared to buying the same watch used. And the Submariner is not alone. The Daytona 116500LN has already crossed this threshold by 12%. Several Submariner references have crossed by 16%. The list is growing every quarter. What this means in practice is profound. For 2 decades, the secondary market for steel Rolex sports models existed at a premium to retail, sometimes a modest premium, sometimes a massive one. That premium was the entire investment case. It was what made waiting on a wait list for 2 years rational. It was what made buying a piece you did not love just to get on a list for a piece you did love rational. Take away the secondary market premium, and the entire economic logic of being a Rolex collector at the steel sports tier collapses. There is no upside to playing the dealer game. There is no upside to taking the allocations they push on you. There is no upside, frankly, to buying new at all. If you are finding this useful, hit subscribe. We go deeper on luxury market mechanics here than anywhere else on YouTube. Now let me show you the part of the story that nobody at your local boutique will ever tell you. While the retail secondary gap is closing from one side, it is being attacked from the other side too. China. We covered this in detail in a recent video, but the short version is that the Chinese luxury market, which was the global engine of demand for Rolex from roughly 2018 to 2023, has collapsed. The real estate crisis, the Common Prosperity Initiative, the political pressure on visible displays of wealth, all of it has created a flood of Rolex inventory pouring out of mainland China through Hong Kong into Western secondary markets. Some industry estimates put the volume at tens of thousands of watches per month moving west, much of it being absorbed by gray market dealers in London, Miami, and New York who never expected this kind of supply. That supply has to be priced into the market. It is. And it is not coming from the brand. Rolex is not flooding the market. Rolex is doing the opposite, restricting supply, killing references, and gating allocation. But the unofficial market is doing what Rolex will not. It is pushing prices down because demand cannot absorb this scale of supply at peak era pricing. And here is the part that should sober every collector who is still in the appreciation mindset. This Chinese inventory has nowhere to go but Western consumers. It does not get reabsorbed back into Chinese demand because the demographic that drove that demand has been culturally and politically deprecated. The political wind in Beijing has shifted permanently against ostentatious wealth display, and there is no scenario where the next 5 years look anything like the last 10 years for Chinese luxury spending. The supply pressure is structural and permanent. So what does this mean for the man in our story? The 52-year-old in Chicago who bought a steel Daytona in 2022. It means 3 things, none of them comfortable. First, the paper loss on his watch is real, and it is not going away. The combination of increasing secondary supply and compressed retail pricing has created a permanent ceiling roughly 20 to 30% below his cost basis. He can wait 10 years and the watch will probably hold or modestly appreciate from current levels, but the path back to $50,000 does not exist in any reasonable forecast. Second, his future buying calculus has fundamentally changed. The implicit appreciation that made the dealer game economically rational is gone. If he wants another watch, the smart move is not to chase another waitlist allocation. The smart move is to buy on the secondary market from inventory the dealer system can no longer absorb. Third, and this is the part that creates a deeper psychological problem. He was sold a story he believed. The watch industry, the financial media, and his own dealer all participated in selling it. The investment narrative about watches was profitable for everyone except the end buyer. Dealers made margin. Auction houses made commissions. The financial press got engagement on a luxury beat. The collectors who bought into that story are the ones who ended up paying the bill. There is one footnote here, and it matters. Not every Rolex is in this situation. Gold and vintage references have held value substantially better than steel sports models because gold prices have risen and the speculation cycle never fully attached to those references. Vintage Rolex, the 5-digit references from the 70s and 80s, has been completely unaffected by the speculation cycle and continues to perform on its own collector dynamics. And certain ultra-limited modern references, like the Platinum Day Date or the off-catalog Daytonas, continue to appreciate because they were never part of the retail versus secondary gambit. The collectors who quietly bought these segments instead of chasing the steel sports hype look extraordinarily smart in retrospect. But they were always a minority. The mainstream collector, the man in Chicago, the dentist in Phoenix, the lawyer in Boston, bought the story they were sold. And the story was about steel. So here's the question I want to leave you with. If the appreciation narrative was the entire economic case for being a collector at the steel sports tier, and that case is now structurally broken, what does Rolex collecting look like in 2030? Does the entire culture of waitlists and dealer relationships and purchase histories survive once the economic reward is gone? Or does it quietly contract back into something it was before 2018? A hobby for people who love mechanical watches, sized to the actual demand for mechanical watches and priced according to what people are willing to pay to wear them rather than to flip them. I do not know the answer yet, but I do know that the brands paying closest attention to this question are not Rolex. They are the independents, the precious metal specialists, and the vintage market. They saw what happened to the steel sports tier, and they are quietly building business models that do not depend on speculation. That is the story we will be tracking. If you want to keep up with where luxury is actually moving, not where the headlines say it is moving, hit the subscribe button, turn on notifications, and let me know in the comments whether you are holding, selling, or buying through this correction. I want to hear from the actual collectors, not the dealers. Thanks for watching. We will see you next time.